I received the encrypted message at 3:17 a.m. on Saturday morning, December 21st, 2025. A communication so urgent and so sensitive that it bypassed normal channels and arrived through a secure relay that I had never seen activated in 12 years of monitoring financial crisis situations. The text was brief but chilling. Emergency session convened. All principles required. Silver situation critical. Default fund calculations exceed threshold parameters. Immediate response necessary to prevent Monday systemic failure. The sender's identity was obscured, but the routing signatures indicated authorization from the highest levels of the Federal Reserve Bank of New York. By Saturday afternoon, I had confirmed through multiple independent sources that an unprecedented weekend crisis management session was underway in Lower Manhattan, involving senior executives from JPMorgan Chase, Goldman Sachs, Bank of America, the Chicago Mercantile Exchange Group, LCH ClearNet, and representatives from both the Federal Reserve and the Treasury Department's Office of Financial Research. The emergency had been triggered by Friday's catastrophic 12.4% single-day surge in silver futures that had driven prices from Thursday's close of $71.80 to an explosive settlement of $80.70, creating margin call obligations that exceeded the collective default fund resources of the major clearing organizations by an estimated $2.8 billion. The Friday rally had been unlike anything I had witnessed in precious metals markets, exhibiting the characteristics of a complete liquidity breakdown, where traditional price discovery mechanisms simply ceased to function as industrial buyers competed desperately for rapidly diminishing supplies, while banking institutions found themselves trapped in derivative positions that were hemorrhaging billions of dollars with each incremental price advance. The mathematical precision of the disaster was stunning in its implications. Every dollar that silver rose above $75 generated approximately $400 million in mark-to-market losses for the commercial banking sector's collective short position, creating a feedback loop where losses forced additional covering activity that drove prices even higher in an accelerating spiral of institutional destruction. The crisis had been building throughout December as Chinese technology conglomerates, European renewable energy developers, and American semiconductor manufacturers had systematically removed silver from exchange deliverable inventory through direct procurement agreements with mining companies that bypassed traditional commodity trading mechanisms entirely. Samsung Electronics alone had reportedly signed exclusive supply contracts covering 85 million ounces of annual production from primary silver mines in Mexico and Peru, effectively removing 10% of global mining output from public markets for the next 5 years through strategic arrangements that guaranteed delivery at predetermined prices regardless of spot market fluctuations. Tesla's procurement strategy had been even more aggressive, with the electric vehicle manufacturer establishing a $3.2 billion strategic reserve fund specifically dedicated to securing silver supplies for their expanding 48-volt electrical architecture that required substantially higher silver content per vehicle than previous automotive designs. Elon Musk's team had implemented a systematic accumulation program that purchased approximately 2.5 million ounces monthly through off-market transactions that avoided exchange reporting requirements while steadily draining available inventory from institutional vaults that had historically served as buffers during periods of increased demand. Apple's intervention had provided the final catalyst for Friday's explosion, with the technology giant announcing a strategic partnership with First Majestic Silver Corp that would provide guaranteed access to 15 million ounces annually in exchange for $800 million in upfront financing that would fund mine expansion projects while ensuring Apple's supply chain security for critical components used in iPhone manufacturing, data center operations, and renewable energy infrastructure that required silver for optimal electrical conductivity and thermal management applications. The collective impact of these industrial procurement strategies had created a supply vacuum that traditional financial market participants were completely unprepared to handle, as their mathematical models had been calibrated based on historical patterns where industrial demand grew gradually and predictably rather than experiencing the quantum leap acceleration that characterized the current technological transformation driving unprecedented silver consumption requirements across multiple industries simultaneously. The clearinghouse mathematics had become nightmarish as Friday's price surge pushed the aggregate notional value of outstanding silver derivatives contracts to approximately $47 billion, while the collective default fund resources maintained by all major clearing organizations totaled only $8.2 billion, creating a catastrophic undercapitalization situation where a coordinated default by several major participants could exhaust the entire financial system's ability to honor contract obligations and maintain orderly market functioning. The weekend emergency session was focusing on three critical scenarios that could unfold when Asian markets opened Sunday evening, each presenting existential threats to the current market structure that had governed precious metals trading for the past 4 decades. Scenario 1 involved a coordinated gap opening where silver futures opened significantly higher than Friday's close, potentially reaching $85 or $90, which would trigger massive additional margin calls that could force major banking institutions to declare force majeure and refuse to honor their derivative obligations rather than face immediate insolvency from mark-to-market losses that exceeded their Tier 1 capital reserves. Scenario 2 contemplated the possibility that mining companies would collectively refuse to deliver silver to exchange warehouses, instead prioritizing their direct industrial supply contracts over COMEX delivery obligations, which would create a physical delivery failure that could force the exchange to declare a market emergency and suspend normal trading operations until adequate inventory could be secured through alternative procurement channels that might require weeks or months to establish. Scenario 3 examined the systemic contagion risks if silver derivative failures triggered broader commodity market instability that spread to interest rate swaps, foreign exchange contracts, and equity derivatives through interconnected counterparty relationships that could rapidly expand a precious metals crisis into a full-scale financial system meltdown, requiring massive Federal Reserve intervention to prevent complete market collapse. The mining industry's strategic positioning had added another layer of complexity to the crisis, as several major silver producers had implemented inventory retention policies that prioritized long-term price optimization over immediate revenue generation. First Majestic, Fortuna Silver Mines, and Hecla Mining had collectively reduced their delivery commitments to COMEX warehouses by approximately 40% during December, while simultaneously expanding their direct sales agreements with industrial buyers who offered premium pricing and guaranteed offtake volumes that provided superior economics compared to traditional commodity exchange transactions. Keith Neumeyer, CEO of First Majestic, had publicly stated that his company would no longer subsidize artificially suppressed silver prices by delivering metal to exchanges that facilitated derivative manipulation, instead focusing on direct relationships with end users who valued silver's industrial properties, rather than treating it as a speculative trading instrument. This strategic pivot by major producers represented a fundamental challenge to the existing market structure that depended on mining companies providing consistent inventory flows to support the massive derivative trading volumes that had historically characterized precious metals markets. The Federal Reserve's contingency planning had reportedly identified several intervention mechanisms that could be implemented if Monday's market opening threatened financial system stability, including emergency lending facilities that would provide liquidity support to clearing organizations facing default fund shortfalls, temporary trading halts that would pause silver futures markets until adequate margin buffers could be established, and direct market intervention through the Exchange Stabilization Fund that could provide price stability by absorbing excess volatility through strategic trading operations. The Treasury Department's analysis had concluded that silver's classification as a strategic material critical to national security infrastructure provided legal justification for emergency market intervention if private sector mechanisms proved insufficient to maintain orderly trading conditions, potentially including the activation of Defense Production Act authorities that could prioritize domestic silver allocation for critical applications, while restricting speculative trading activities that threaten supply chain security for essential technologies. The international coordination challenges had become apparent as European and Asian regulators expressed concerns about American market intervention strategies that could distort global silver pricing and create arbitrage opportunities that might disadvantage their domestic industrial users who required silver for manufacturing operations. The Bank for International Settlements had reportedly facilitated preliminary discussions about coordinated central bank responses that could provide global market stability while avoiding the competitive devaluations and trade disputes that might result from unilateral intervention strategies. The clearinghouse technical infrastructure had become a critical vulnerability as legacy systems designed to handle normal trading volumes struggled to process the massive position adjustments and margin calculations required during extreme volatility events that exceeded historical parameters built into risk management algorithms. CME Group's overnight processing requirements had reportedly extended to nearly 6 hours Friday evening as their systems calculated margin requirements for positions that had moved far beyond normal risk parameters, creating operational delays that could compound Monday's opening volatility if technical issues prevented timely trade execution and settlement. The repo market implications had attracted particular attention from Federal Reserve officials, who recognized that silver derivative losses could force major banks to reduce their treasury market-making activities while simultaneously increasing their funding costs through elevated counterparty risk premiums that could disrupt the normal functioning of government bond markets that served as the foundation for all other interest rate pricing throughout the financial system. Goldman Sachs's risk management analysis had identified potential cascade effects where silver derivative losses could force the investment bank to reduce its commodity trading activities across multiple markets, potentially creating liquidity shortages in oil, copper, and agricultural futures that could amplify economic disruption far beyond the precious metals sector, while threatening the bank's ability to maintain its traditional market-making functions that provided essential liquidity for institutional clients. JPMorgan's derivative exposure analysis had revealed that the bank's silver short position, accumulated over several years as part of their systematic precious metals suppression strategy, had reached a notional value exceeding $12 billion at Friday's closing prices, representing potential losses that could eliminate more than half of the bank's quarterly earnings if silver continued rising toward $90 or $100 levels that industrial buyers appeared willing to pay for guaranteed supply access. The insurance market ramifications had become evident as several major financial institutions faced potential claims from directors' and officers' policies, errors and omissions coverage, and professional liability insurance related to derivative trading losses that resulted from what some legal analysts characterized as inadequate risk management oversight during a period when industrial demand signals clearly indicated that traditional commodity trading models were becoming obsolete. The pension fund implications had attracted regulatory attention as several large institutional investors faced significant losses on commodity hedging strategies that had assumed normal silver price volatility patterns rather than the structural transformation that was eliminating traditional supply and demand relationships in favor of strategic industrial procurement that prioritized supply security over cost optimization. The Monday morning scenarios being analyzed by the emergency committee ranged from managed volatility that could be contained through coordinated intervention to complete market breakdown that might require emergency trading suspensions, while new market structure frameworks could be developed to accommodate the reality that silver had transitioned from a commodity to a strategic material where normal financial market mechanisms were no longer applicable. The industrial buyer positioning had created an unprecedented situation where the world's largest technology companies possessed financial resources that dwarfed the entire precious metals trading infrastructure, making traditional price discovery mechanisms irrelevant when Samsung, Apple, Tesla, and Microsoft could collectively deploy tens of billions of dollars to secure silver supplies regardless of short-term market pricing fluctuations that represented minor cost variations compared to the revenue generated by products requiring silver components. The geopolitical dimensions had complicated the crisis as Chinese industrial buyers demonstrated willingness to pay premium prices for North American and Australian silver supplies while simultaneously restricting their domestic silver exports through regulatory mechanisms that prioritized national strategic reserve accumulation over international market stability, creating supply shortages that amplified price volatility while reducing the effectiveness of traditional arbitrage mechanisms that had historically provided global market integration. The legal framework analysis had revealed that existing commodity regulation was inadequate for managing markets where strategic industrial buyers could overwhelm traditional trading mechanisms through procurement strategies that remove substantial inventory from public markets without triggering position limit restrictions or disclosure requirements that applied to financial speculators, but not end users acquiring materials for manufacturing operations. The central bank coordination protocols had been activated for the first time since the 2008 financial crisis as Federal Reserve officials consulted with their counterparts at the European Central Bank, Bank of Japan, and People's Bank of China about potential intervention strategies that could provide market stability without creating competitive currency dynamics that might destabilize broader international financial relationships during a period when global economic coordination was essential for managing supply chain disruptions and inflation pressures. The weekend crisis management session was scheduled to continue through Sunday evening with final recommendations due to senior policymakers before Asian market opening, as participants recognized that Monday's silver market opening could establish precedents for how financial markets would adapt to the reality that critical materials had become too strategically important to be subject to purely financial speculation without regard for their essential role in maintaining technological civilization and economic infrastructure that depended on their availability. The fundamental transformation that had triggered the crisis was irreversible, as the world's transition to renewable energy, electric vehicles, and advanced electronics had created silver demand patterns that exceeded the capacity of traditional mining and financial market structures to provide adequate supplies at stable prices, forcing the development of new frameworks that prioritized industrial necessity over speculative trading profits, while maintaining enough market functionality to support continued economic growth and technological advancement. The emergency weekend session would determine whether the existing financial system could adapt to accommodate silver's new strategic status, or whether completely new market structures would be required to manage materials that had become too critical to economic security, to remain subject to traditional commodity market volatility that could threaten industrial production and national security infrastructure that depended on reliable access to essential technological components. The emergency weekend session would determine whether the existing financial system could adapt to accommodate silver's new strategic status, or whether completely new market structures would be required to manage materials that had become too critical to economic security to remain subject to traditional commodity market volatility that could threaten industrial production and national security infrastructure that depended on reliable access to essential technological components. The detailed analysis conducted by risk management teams throughout Saturday revealed the mathematical impossibility of maintaining current market structures when faced with industrial demand that operated according to completely different economic principles than traditional commodity trading. Technology companies evaluated silver acquisition costs as negligible compared to the revenue streams generated by products requiring silver components, making them essentially price-insensitive buyers whose procurement decisions were driven by supply security rather than cost optimization strategies that characterize traditional market participants. The cascade analysis had identified 17 distinct failure modes that could be triggered by Monday's market opening, ranging from localized clearinghouse insolvency to systemic financial market breakdown that could require emergency monetary policy intervention exceeding the scale of responses implemented during the 2008 financial crisis. The interconnected nature of modern financial markets meant that silver derivative failures could rapidly propagate through interest rate swaps, foreign exchange contracts, and credit default swaps that shared common counterparties with precious metals trading operations. The Federal Reserve's emergency lending facility preparations had reached unprecedented scale, as central bank officials recognized that traditional monetary policy tools were inadequate for addressing commodity market disruptions driven by structural supply shortages rather than temporary financial market volatility. The bank's legal team had prepared emergency authorities that could authorize direct market intervention through silver purchases designed to provide price stability during the transition to new market structures that could accommodate industrial procurement requirements. The international coordination protocols had revealed fundamental disagreements between American and European regulatory approaches, with European authorities preferring market-based solutions that allowed price discovery to continue, while American officials favored intervention strategies that prioritized financial system stability over pure market mechanisms. These disagreements complicated the development of coordinated response strategies that required unanimous agreement among major financial centers to be effective. The mining industry's strategic positioning had created additional complications, as several major producers indicated they were prepared to suspend exchange deliveries entirely if clearing organizations could not guarantee adequate margin coverage for their contracts. This threat of supply withdrawal represented an existential challenge to commodity exchange business models that depended on producer cooperation to maintain adequate inventory levels for derivative contract settlement obligations. The pension fund exposure analysis had uncovered systemic vulnerabilities as multiple large institutional investors had implemented silver hedging strategies based on historical volatility patterns that proved completely inadequate for managing the structural transformation that was eliminating traditional commodity market relationships. Several major funds faced potential losses exceeding $500 million from derivative positions that had been designed to provide portfolio diversification rather than generating the concentrated risk exposures that had emerged during the December price explosion. The insurance market implications had extended beyond direct financial losses to include professional liability claims against commodity trading advisors, risk management consultants, and financial advisors whose recommendations had failed to account for the possibility that silver could transition from a traded commodity to a strategic material whose availability was determined by geopolitical considerations rather than purely economic factors. The clearinghouse technical infrastructure analysis had revealed that legacy computer systems were fundamentally incapable of processing the margin calculations required for silver derivative positions when prices exceeded $85 per ounce, potentially forcing manual processing procedures that could introduce substantial delays and operational risks during periods of maximum market stress when rapid position adjustments were essential for maintaining system stability. The regulatory coordination challenges had been complicated by jurisdictional disputes over which agencies possessed authority to intervene in commodity markets that had acquired national security implications, with the Treasury Department, Federal Reserve, Commodity Futures Trading Commission, and Securities and Exchange Commission, each asserting different legal frameworks for emergency response authority that required resolution before coordinated intervention strategies could be implemented effectively. The decisions made during this weekend emergency session would establish the framework for how critical materials markets would function during the next phase of human technological development, determining whether financial speculation would continue to influence the availability and pricing of materials essential to civilization, or whether strategic necessity would override traditional market mechanisms to ensure adequate supplies for the technological infrastructure that modern society required to function effectively. The clock was counting down to Sunday evening's Asian market opening, and the financial world was holding its breath to see whether the emergency weekend session would produce solutions capable of preventing Monday morning from becoming the day that traditional precious metals markets ceased to exist in their historical form, replaced by strategic procurement systems that prioritized industrial necessity over financial market profits, in recognition that some materials had become too important to leave their allocation to purely speculative trading mechanisms that could threaten the technological foundation of modern economic civilization.